Cryptocurrency. A cryptocurrency is a digital or virtual currency that uses cryptography for security. It operates on decentralized networks based on blockchain technology, which ensures transparency and immutability. Cryptocurrencies enable peer-to-peer transactions without the need for intermediaries like banks. Blockchain. Blockchain is a distributed ledger technology that records all transactions across the networks of computer. It consists of a chain of blocks, each containing a list of transactions. Blockchain ensures data integrity and security through cryptographic hashing and consensus mechanism. Bitcoin. Bitcoin is the first and most well-known cryptocurrency created by an anonymous person or group known as Satoshi Nakamoto in 2009. It serves as a digital store of value and medium of exchange, often referred to as digital gold. Bitcoin operates on a centralized blockchain network. Altcoin. Altcoins are any cryptocurrency other than Bitcoin. Examples include Ethereum, Ripple, Litecoin, and many others. Altcoin often introduce unique features or improvements over Bitcoin, such as faster transaction speeds, enhanced privacy, or smart contract functionality. Ethereum. Ethereum is a decentralized platform that enables developers to build and deploy smart contracts and decentralized application. Its native cryptocurrency, Ether, is used to power transaction and computational services on the network. Ethereum blockchain supports a wide range of use cases beyond simple transaction. Smart contract. A smart contract is a self-executing contract with terms of agreement directly written into code. These contracts automatically execute and enforce the terms when predefined conditions are met, reducing the needs for intermediaries and enhancing trust and efficiency in transactions. Decentralized finance. DeFi refers to as a financial system built on a blockchain technology that aims to recreate traditional financial services, such as lending, borrowing, and trading, without intermediaries. DeFi platforms use smart contracts to automate and secure financial transactions, offering greater accessibility and transparency. Stablecoin. A stablecoin is a type of cryptocurrency designed to maintain a stable value by being pegged to a reserved asset, such as a fiat currency like the US dollar or a commodity like gold. Stablecoins aim to provide the benefits of cryptocurrency while minimizing volatility. Initial coin offering. An ICO is a fundraising method used by blockchain projects to raise the capital by issuing and selling new cryptocurrency tokens. Investors purchase these tokens in the hope that their value will increase as the project develops. ICOs are similar to IPOs but are typically less regulated. Token. A token is a digital asset issued on a blockchain representing ownership, utility, or other rights within a specific ecosystem. Tokens can be categorized into utility tokens, which provide access to services or products, and security tokens, which represents investment assets. Wallet. A cryptocurrency wallet is a digital tool that allows users to store, send, and receive cryptocurrency. Wallets come in various forms, including software wallets, mobile or desktop apps, hardware wallets, physical devices, and paper wallets, printed keys. They store in the private and public keys needed to access and manage cryptocurrency holdings. Private key. A private key is a secret code that allows the holder to access and manage their cryptocurrency. It is crucial for signing transactions and proving ownership of blockchain assets. Keeping the private key secure is essential, as losing it can result in the loss of funds. Public key. A public key is a cryptographic code associated with a private key. Used to receive cryptocurrencies, it acts as an address that others can use to send funds to the wallet. The public key can be shared openly, while the private key must remain confidential. Mining. Mining is the process of validating and recording transactions on a blockchain by solving complex cryptographic puzzles. Miners use powerful computers to compete for the chance to add new block to the blockchain that earns rewards in the form of newly created cryptocurrency and transaction fees. Proof of work, POW, is a consensus mechanism used by many cryptocurrency, including Bitcoin, to secure the network and validate transaction. It requires miners to perform computational work to solve cryptographic puzzles, ensuring that the blockchain remains tamper-proof and decentralized. Proof of stake, POS, is an alternative consensus mechanism where validators are chosen to create new blocks based on the numbers of tokens they hold and are willing to stake as collateral. POS is more efficient in POW and aims to reduce the environmental impact of blockchain operation. Node. A node is a computer connected to a blockchain network that stores and verifies the blockchain's complete history. Nodes ensure the integrity and security of the network by participating in the consensus process and propagating transaction data across the network. Fork. A fork occurs when a blockchain splits in two separate chains due to differences in protocol or software changes. Forks can be soft or hard. Hard forks often results in the creation of a new cryptocurrency. Gas. Gas is a unit used to measure the computational effort required to execute transaction and smart contracts on the Ethereum network. Users pay gas fees to compensate miners for the resources used. Gas fees fluctuate based on the network demand and transaction complexity. Decentralized Application. A dApp is an application that runs on a decentralized blockchain network, leveraging smart contracts to operate without a central authority. The app offers various services including finance, gaming, and social media, with increased transparency and security. Exchange. A cryptocurrency exchange is a platform where users can buy, sell, and trade cryptocurrencies. Exchanges can be centralized, operated by a company, or decentralized, running on a blockchain technology without intermediaries. Exchanges provide liquidity and market access for cryptocurrency traders. HODL. HODL is a slang term derived from the misspelling of hold, referring to the strategy of holding onto cryptocurrency long-term rather than selling them. It reflects a belief in the future value of cryptocurrency despite market volatility. Whale. A whale is an individual or entity that holds large amount of cryptocurrency. Whales can influence market prices through their significant buying or selling activities, often causing notable price movements in the market. Pump and dump. Pump and dump is a manipulative scheme where the price of cryptocurrency is artificially inflated, pumped through false or misleading statements, followed by a rapid sell-off to profit from the increased price. This practice is illegal and unethical. Cold storage. Cold storage refers to keeping cryptocurrency holdings offline to protect them from hacking and cyber theft. Methods include hardware wallets, paper wallets, and other offline storage devices. Cold storage is considered one of the most secure ways to store cryptocurrencies. Hot wallet. A hot wallet is a cryptocurrency wallet that is connected to the internet, making it convenient for transactions, but more vulnerable to cyber attacks. Hot wallets are typically used for frequent trading and small amounts of cryptocurrency. Satoshi. A Satoshi is the smallest unit of Bitcoin, equal to 0.00001 BTC, named after Bitcoin's creator Satoshi Nakamoto. It represents a tiny fraction of a Bitcoin and is often used to denote small transactions or to express fractions of a Bitcoin. Tokenomics. A tokenomics refers to the economic model and incentive structure of a cryptocurrency or token. It includes the distribution, supply, and demand factors that influence a token's value and utility within its ecosystem. Understanding tokenomics is crucial for assessing the viability of cryptocurrency project. White paper. A white paper is a detailed document published by a cryptocurrency project outlining its technology, purpose, and roadmap. It provides potential investors and users with comprehensive information about the project's goals, architecture, and underlying technology. Burning. Burning refers to the process of permanently removing a certain amount of cryptocurrency from circulation, reducing its total supply. This is typically done by sending the tokens to an unspendable address. Token burning can increase scarcity and potentially boost the value of remaining tokens. Airdrop. An airdrop is a distribution of cryptocurrency tokens to a large number of wallet addresses, often as a marketing strategy or reward. Airdrops are used to increase awareness, promote adoption, and reward community members. Recipients usually need to meet specific criteria to qualify. KYC, Know Your Customer. KYC is a regulatory process that requires financial institutions and exchanges to verify the identity of their customers. KYC aims to prevent fraud, money laundering, and other illicit activities. Users typically need to provide identification documents and personal information during the KYC process. Anti-money laundering. AML refers to a set of laws, regulations, and procedures aimed at preventing money laundering and other financial crimes. Cryptocurrency exchanges and financial institutions implement AML measures to comply with the regulatory requirements and ensure the legitimacy of transaction. Market cap. Market cap or market capitalization is the total value of cryptocurrency calculated by multiplying its current price by the total supply of coins or tokens in circulation. Market cap is used to compare the relative size and value of different cryptocurrency. Fear of missing out. FOMO is the psychological phenomenon where investors feel compelled to buy a cryptocurrency due to the fear of missing out potential profits. FOMO can lead to impulsive decision and contribute to market volatility. Do your own research. DYOR is an acronym encouraging investors to conduct their own research before making investment decision. It emphasizes the importance of independent analysis and due diligence to avoid relying solely on external advice or hype. Fiat currency. A fiat currency is government-issued money that is not backed by a physical commodity like gold. Examples include the US dollar, euro, and yen. Cryptocurrencies are often traded against fiat currencies on exchanges. Initial coin offering. An ICO is a fundraising method where cryptocurrency project sells a portion of its token to early investors in its exchange for capital. ICOs are used to raise funds and development launch. Investors hope that the tokens will appreciate in value as the project succeeds. Initial exchange offering. An IEO is similar to an ICO, but conducted on cryptocurrency exchange platform. The exchange acts as an intermediary, conducting due diligence on a project and facilitating the token sale. IEO aims to provide greater security and credibility compared to ICOs. Security token offering. An STO involves the issuance of security tokens that represents ownership in underlying asset, such as shares in a company or real estate. STOs are subject to regulatory compliance and offer investors legal rights, including profit sharing and voting. Non-Fungible Token. NFTs are unique digital assets that represent ownership of a specific item, such as art, music, or virtual real estate. Unlike cryptocurrency, NFTs are invisible and cannot be exchanged on one-on-one basis. They are used to verify ownership and authenticity of digital and physical items. Liquidity Pool. A liquidity pool is a collection of funds locked in a smart contract to facilitate trading on decentralized exchanges. Liquidity pools provide the necessary liquidity for token swaps and yield farming, with liquidity providers earning fees or rewards in return. Yield farming. Yield farming is a DeFi practice where users stake or lend their cryptocurrencies in exchange for rewards, typically in the form of additional tokens. Yield farmers move their funds across different protocols to maximize returns, contributing to the liquidity and functionality of DeFi platforms. Staking. Staking involves locking up a certain amount of cryptocurrency to support the operations of a blockchain network, such as validating transactions and securing the network. In return, stakers earn rewards in the form of additional tokens. Staking is commonly associated with POS blockchains. Decentralized Autonomous Organization. A DAO is an organization governed by smart contracts and decentralized voting mechanism. Rather than a centralized authority, members hold the tokens that represents voting power, enabling them to participate in decision-making process and manage the organization collectively. Governance Token. A governance token grants holders the right to vote an important decision within blockchain protocol or DeFi project. These decisions can include changes to the protocol, allocation of funds, and other governance matters. Governance tokens incentivize community participation and decentralized management. Rug pull. A rug pull is a type of scam in the DeFi space where developers create a seemingly legitimate project, attract investors, and then suddenly withdraw all the funds, leaving investors with worthless tokens. Rug pulls exploit the decentralized and often anonymous nature of DeFi. Cross-chain. Cross-chain refers to the ability to transfer assets and data between different blockchain networks. Cross-chain solutions aim to improve interoperability and enable seamless interactions between various blockchains, enhancing the overall functionality of the cryptocurrency ecosystem. Atomic swap. Atomic swap is a smart contract technology that enables the exchange of cryptocurrency from different blockchains without the need for intermediaries. Atomic swaps ensures that exchange is completed if and only if both parties fulfill their respective conditions, enhancing security and efficiency. Layer 2. Layer 2 solutions are secondary frameworks built on top of existing blockchains to improve scalability and transaction speeds. Examples including the Lightning Network for Bitcoin and various rollups for Ethereum. Layer 2 solutions help to reduce congestion and lower transaction cost. These terms are fundamental to understanding the cryptocurrency market and navigating its complex and rapidly evolving landscape.